You spent years of hard work, blood, sweat, and tears building your business. When the final time comes to sell, do not ignore capital gains. It could cost you millions of dollars. On today's episode, we're going to talk about just that. I'm joined by my fellow growth thinker, Geoff Sokol from GT Investment Management, our resident wealth advisor. Geoff, welcome to the show.
Thanks, Tim. Good to be back on, and congratulations on the success of the program.
Hey, you got it, man. It's people like you that make this episode awesome. So thanks for joining and being my sidekick here. Excited to talk about capital gains because it is a massive conversation. It's not a one episode conversation. I think we're going to have to turn this into more bits of info. But just to start, what are capital gains? Let's take it at the most highest level. Why should business owners be aware of capital gains?
Well, sure. I'm sure they've heard about it more these days. This is a hot topic. I'm sure it's getting a little bit more play than it otherwise might because of the heated election season. Different candidates with some different ideas. But capital gains at the highest level, you have capital gains and capital losses that can be either long-term or short-term. Long-term classification is if you've held the asset for longer than 365 days, and it would be treated at different tax rates according to if it was long-term. If it's short-term, that's anything less than 365 days, which typically is going to be taxed at a higher rate. So the first thing the tax system is going to reward is patience in that regard.
Yeah. So as it relates to, let's say, business owners, because it's easy to understand capital gains in the realm of a stock. I mean, the easiest example is you buy a stock for 10, you sell it for 30, you have your gains in the middle, you pay taxes on it. But if you're a
Sure.
business owner who started your business, let's say 30 years ago, and you're starting to think about an exit, and you know at some point in time, you're going to have to pay some capital gains on this is what gives business owners pause and makes them concerned. And they wonder, what can I do to lower this rate? And what is capital gains anyways, right? I mean, they're so busy building their business, they're not thinking about tax strategies and things of this nature. So how does a business owner even begin to wrap their head around this conversation?
I think the key word there is planning. When you think about exit planning, you don't just wake up one day and decide you're going to sell. There's a series of events that go into it. You're working with your advisory team, and you're doing a lot of planning, going through line by line of everything, taking inventory of your family, your personal situation, the business, and what makes the most sense. I would say it is very similar with capital gains and your capital gains strategy. The example I like to go back to is when you're a founder, and you touched on this a moment ago, you want to build the business, and it's this frantic pace. And if you pull off a miracle and you can make that happen, it's, more, first of all, more power to you. It's an incredible achievement. But whereas one day this thing was valued at zero, now it could be worth tens of millions of dollars. It's this massive jump. And depending what state you're in, when you start to think about taking chips off the table and you hear about a 50% marginal tax rate, you're thinking, you know what? I'm just going to let it ride because
Right.
you've basically gotten yourself into the situation where it's more painful to part ways with the asset than to pay the taxes or one way or the other there. So it's really important to have an idea of how to realize these gains, because when they are only existing on paper, when you haven't been able to really put the cash in your pocket, it's really hypothetical money. So the ability to realize the gain and not experience extreme pain of being in a massively high tax bracket does involve some planning, and there's some strategic accounting you can do to offset the gains with losses or line by line expenses you can write off or tax credits that ultimately you can get yourself into a much lower tax bracket and actually realize that cash in your pocket. So it's not just a hypothetical money on a piece of paper somewhere.
Let's talk about some examples, right? Because I always think it's useful for our audience to hear just some real life practical examples, and you're chock full of them. So maybe there's something that comes to mind when you think about this.
Yeah, there are a few, and I get a little bit sober thinking about it because it's a classic what not to do scenario, and you just hate to see it. The first one is this is about 10, 15 years ago in the boom of the Silicon Valley era, a fintech space. One of the founders of a company, I'll keep his name and the company private, but let's just say they were in a competitive space. They were able to provide a really fantastic service in a marketplace that really needed it, and they boomed. He had a ton of equity compensation. He had founder equity compensation. He had all sorts of stock options that he just decided, you know what, this thing is going to keep going up. We're in a dominant position. We have market share. Then they IPO'd. It went up like, gosh, 10, 20, 50x. I
Oh,
think some of his positions were up like between 100 and 1,000%.
beautiful.
And yeah, I mean, it was wonderful. And I started talking to him, and maybe because I was more of like a friend to him, like we were young guys in our 20s, and I would say, you really should think about exercising. And he just didn't want to hear it.
Mm.
Um, I would talk to him about certain strategies. You don't have to cash it all in, just maybe realize some of it. We can look at ways to offset it either through real estate or putting some assets into a trust or offsetting in a capital loss strategy through tax loss harvesting. And we can get into some of those strategies. But I think the key point here is that ultimately, as it goes in the world of private enterprise, a service that is dominant in the marketplace, what's that going to bring? Competition, of course. Someone finds a way to introduce it at a better way, or they have a better marketing approach, or they have better strategic relationships, whatever it is. Before you know it, Wall Street doesn't like to see market share decreasing. They don't like to see revenue decreasing, or they don't like to see earnings decelerate. So what happens to the stock price? Killed. I think at one point it was $100 a stock or a share, and now it's trading for like $1 or $2 per share. And he
Mm.
never exercised. So to make a long story short, he was so adamant that he would not pay taxes and that his company would keep going up for forever that he never exercised it. And now he went through all this effort to structure businesses abroad, to make sure he was living in a different country for 183 days out of the year to qualify in different tax rates. He did all the hard work. He just didn't do the one thing he needed to do, which was make a plan to realize some of those profits. And now it's gone like the wind.
Yeah, that's such a great example because there's a bit of human greed that we all need to be aware of. It's like you got to have knowledge of self. You got to know what's enough. You have to have a number in mind because you're right, things can come and just completely wipe you out. So I think back to that personal plan, like what works for you? What is it that you're working so hard for? What are you building? And if you can, buy a house and set your kids up for school and have your tax accounts maxed out and buy a house for your mother-in-law or whatever it is that you want to do. It's like you really should have those things mapped out. So when the time the money comes and presents itself, you can take advantage of it. But it is something that you kind of need to sit down and just ask, like, who am I and what am I trying to accomplish? You mentioned putting some of these investments, realizing some of the gains, or having some various shelters with real estate trusts. Let's talk a little bit about that. Let's just talk about real estate in the first place, because I think that's a place we all love to talk about. How
Sure.
does one use capital gains and offset it with real estate?
Well, with real estate, one thing that is cool to think about, and it really reinforces our point about having a good strategic management team or wealth advisory team, is that the individual is treated different than the business. A couple of cases that I've seen would be there's something called a PTET, which is a pass-through entity trust. The way this works at the individual level is that you can write off $10,000. So you could bring your modified adjustable gross income down by 10,000. So if you're in a 40% bracket, you can save about $4,000, which is good. This rule doesn't apply to a business. You don't have a $10,000 ceiling there. So what will happen is if you're working with an accountant, you probably have an individual, like a retail style accountant who's going to treat you as an individual. And then you'd have a business accountant who would probably realize that from the entity's perspective, that it makes more sense to put it there. But when you get your paperwork together, you don't necessarily know as the individual, should I put this here? Should I put this there? And the accountant is unlikely to be able to uncover this for you. So this is why the point before you actually give your paperwork over to someone who's going to file for you, it's really helpful to have somebody who does some strategic consulting at this level that combines the whole person, that whole person approach between the business, the family, the person, and can identify that. Because there's a case that I worked on recently where there's about $1 million worth of income a business owner paid himself, and he did this where he had this pass-through entity trust. He was eligible for it. He could have written off $50,000, which at
Mm.
a 40% bracket would have been worth 20,000, but he had listed it, his real estate, at the individual level, where he only qualified for 10,000. So the opportunity cost there was about $16,000 he left on the table just because he didn't know, and the accountant wasn't in a position to make this type of suggestion.
Oh,
So that's a really important point at a high level, just to say someone who understands you, the way your business is structured, and the type of work that you do is probably immediately going to be able to make some pointers about how to submit your paperwork to get the highest or the best tax treatment.
It's not nothing. $16,000,
Yeah,
not nothing. I mean, there's a lot that you can do with 16,000, and that's just one strategy. What about things
exactly.
like low-hanging fruit? I mean, there's a lot of low-hanging fruit, like maxing out your 401k or setting up education accounts for kids and hiring your family. I mean, what would you say are like maybe three low-hanging fruit items here?
Well, since we mentioned real estate, there's accelerated depreciation of the asset that you can write off, and the maintenance of the real estate as well likely can be brought down from your modified adjustable gross income, which is going to bring you down at the margin. So that's the low-hanging fruit with real estate. If you own real estate in any capacity at the personal level or at the business level, there are write-offs. So that's something to definitely be aware of. If you're ever going to sell real estate, or if you're thinking about a strategic flip of an asset, a 1031 exchange can be a great way to avoid taxation altogether. This is called a like kind exchange. So if my real estate has doubled in valuation and I'm thinking I could sell, but I don't want to pay the tax, you don't have to. If you flip it within 180 days into another property, then you defer that tax altogether. So there are good strategies there. Other ways to bring you down at the margin. That's one of my favorite ones that you mentioned is employing your family. And it's a funny one because I bring this up and people have this, it's kind of funny. They have this reaction like, I don't want the child labor laws coming after me.
Right,
It's like we're in California. They're
right.
pretty strict about these kind of things. And I'm like, no, no, no. I'm not saying you're not going to mistreat your children. The point is, you can pay them up to $14,600 per year. And the benefit of paying them as though they're an employee is that this is now earned income. Now that they have earned income, they can contribute to something like a Roth IRA. So I always joke with my wife that from the time my kids are about 4 or 5 years old, I'll probably never do another house task ever again in my life. And it's great because this goes beyond the money. They have earned income. They can contribute to a Roth IRA. They can be, they could have probably about $100,000 stashed away in a tax deferred asset that they'll never pay tax on by the time they're 18. What a way to enter the world. But then this gets to the point of hopefully they have the right skills or the right emotional understanding. And a benefit of employing the children is you can do things like performance reviews, or you could not pay them a month if they don't clean the dishes properly, if the tax doesn't get or the trash doesn't get taken out. These are opportunities to talk to them about how there are consequences. We had a clearly defined set of tasks for you to complete. It was not up to par, so you're getting, 300 instead of 400 this month, or whatever it is.
You have a lot
So
of
that's
flexibility. You probably have a lot more flexibility than you do with hiring employees. Actually, 100% more flexibility.
I would hope so, unless if you have an 8-year-old taking you to court, then
Right, yeah,
I
yeah.
don't know, I don't know what to do in that situation. But yeah, these are good things to do that set them up nicely. Then they can make contributions to a Roth IRA, to their own 529 plan. They can, have some spending money to go to the movies or whatever the
Mhm.
kids do these days. And the 14,600 that you're paying them was all tax deductible. So again, at a 40% bracket, that's saving you something like $6,000 a year on your taxes.
Yeah, that's amazing. What we're talking about here is we're not giving tax advice. Definitely want to consult with your CPA, but these are strategies, these are things to keep in mind because every little thing that you can do to lower your taxes, you should do because you're creating value in an alternative universe, right? It's money that it's going to go in one of two directions, right? It's going to go into the pocket of Uncle Sam or it's going to go back into your pocket at some point. So you might as well do that because you're already working hard. You're already building these investments. The end of the year is coming. We're moving into the final quarter of this year, and people are starting to wrap their heads around how to like offset taxes before the end of the year. Like, what's your final parting words here for those individuals?
It's a great question. The best thing you can do is not rush to the relationship with the accountant and expect them to solve all of your problems. I joke with other people in the financial planning world that people think about low taxes like ordering a coffee at Starbucks. It's like you show up at the accountant's office and say, I don't want to pay all this taxes. And it's like, okay, there's a lot of work we got to do here.
Mhm.
So I don't want to have an off-putting message that it's a lot of work. I'd rather think of it that you have your whole life ahead of you, whatever stage you are at, or your family's at, or your business is at. We have time to do this. I wouldn't say to be patient and to procrastinate, but think about this like, let's say we're going to really attack this thing for the next year or so to plan for the next 5 or 10, then great, let's get a meeting scheduled for next week. Let's just put 30 minutes on the calendar, start to gather the documents, do a risk assessment, a client profiling, and let's figure out where the money is, what the business is worth. And as we go along, we can unlock opportunities to create more value while we're extracting value from the business, while we're planning to realize that gain and offset it with a loss. So the whole experience is more beneficial, optimized, and not going to end up with you cutting a big check to the tax man.
So if you're out there in the audience and if you made it this far in the podcast, I'm going to assume that you have a need. I'm going to assume that this topic is of interest and that you can benefit from a lot of these strategies that we're talking about. So with that being said, I want you to reach out. Geoff, hit us with your email address.
First dot last name. That's Geoff with a G off. So you can't don't do the Jeff. It's Geoff dot Sokol Sokol at gtria.com. We'll leave my phone number down there as well. We always joke around that cut through the noise. Just give me a call. We'll leave my phone number down there as well, and feel free to reach out anytime. We do all complimentary analysis for this type of stuff, and we are very happy to help. So by all means, don't be shy.
Awesome. Thanks, Geoff. Please like, comment, and subscribe, share, tell a friend, put it on your socials, but most importantly, take action. So thanks.